Look, we cover an industry that is a legacy older industry. And we tend to see during times of considerable transition, um, industries hitting maturity and trying to survive, trying to find ways to survive. There are so many forces hitting the energy sector today. There is the natural maturation of what the industry does, and that is explore, produce, and repeat. But at some point, the industry will likely hit this its capacity to produce. Right? I mean, we only have so much land, we only have so much space, we only have so much drillable locations. So there's that aspect. There's also the geopolitics. There's also demographics. There is the internal civic unrest related to legacy oil and gas versus newer technologies.
Good morning, good afternoon, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We've got a little bit of a special conversation today. We got two analysts. You know Vince Piazza well. He's a regular, joins this call at least once or twice a month. And we've got also Vince's associate, Evan Lee, joining. And the reason we've got the two of these guys on the call today is they have published a new deep dive. I think the title is pretty provocative. U.S. E&Ps Outlook, Fewer, Bigger, and More Concentrated. And if you don't know our deep dives, there are basically 40, 60-page classical reports. I know we don't tend to do those at BI very often, and they're thematic. They try to unpack a topic. You can find them on the terminal by typing BI Deep Go, where you'll see Vince and Evan's report, as well as numerous other ones that myself and other members of the team have published, but also ones on technology and pharmaceuticals. It really runs the gamut. So make sure to check it out as a landing page for the terminal. But Vince, I want to come to you first. And we're wrapping up 2024, heading into 2025. Give us your sense of kind of just what does it look like in the U.S. E&P space, and how does I like your title, but help us understand kind of really how you're seeing the industry right now.
Yeah, hey, thanks for having us on, and thanks for spending time with us talking about this deep dive. For those who follow my work, this is a pretty consistent theme that we've had for quite some time. Look, we cover an industry that is a legacy older industry. And we tend to see during times of considerable transition, industries hitting maturity and trying to survive, trying to find ways to survive. There are so many forces hitting the energy sector today. There is the natural maturation of what the industry does, and that is explore, produce, and repeat. But at some point, the industry will likely hit its capacity to produce. Right? I mean, we only have so much land, we only have so much space, we only have so much drillable locations. So there's that aspect. There's also the geopolitics. There's also demographics. There is the internal civic unrest related to legacy oil and gas versus newer technologies. And that is the transition that the industry has battled over time. We sit here today with an industry that is roughly less than 4% in the S&P 500 after a period of significant growth where it peaked in the mid-teens during the commodity super cycle, and it has declined ever since as new technologies come about. And guys, consider this, oil was the new technology generations ago, right? Um, Whale oil was the thing back then. So things happen to change the focus of the end markets and bring in these new technologies. And so we're at this point, this transitional phase, where this industry was once a growth industry and now it has hit this maturation. So what happens when you have all of these forces coming at you? How do you survive? How do you get to that next step? Well, part of it is consolidation. Part of it is consolidation and bringing assets into stronger hands and larger hands. So the consolidation phase. You also have a period of technological evolution within the companies themselves. So new ways of drilling, for example, unconventional drilling, drilling laterally. You also have financial management and the trends toward changing the corporate structure, the capital structure as well. So you have a period where companies were spending to create the resource, to find the resource, to delineate the efficacy of the resource. And now we're moving toward this manufacturing process where it's less capital intensive and more capital generative, where free cash flow is now king. So cash is king. And how do you spend that cash? How do you engage the shareholder? So that's what this report is really trying to encapsulate in the 40 some odd pages of very small print. But that's what this report is really offering. And we offer, along with some of Evan's commentary, who we think the eventual winners are and who we think still has some challenges in this new environment. And we can get into that as much detail, but I also want to bring in Evan, who is my senior associate. He's been with us for several years, and he's also launched some coverage on some of his names as well. And he has some interesting thoughts on how his names will likely proceed from here. And then I can also back that up with some commentary on some of the larger companies and what they will likely do going forward.
Yeah, sure. Thanks, Vince. So I just want to, start by talking a little bit about the M&A trends that we've been seeing in the past few years for the small and mid-cap publicly traded E&Ps. If you take a look at M&A activity over this past year amongst this subsector of E&Ps, it's been about $18 billion in announced deal value. And if you look at the year prior to that, it's been about $23 billion of announced deal value. Both of those are above pre-COVID levels. And this really drives home the point, our long-held view that, in order to stay relevant, in order to stay competitive, this sector of E&Ps, they need to continue building scale through M&A. There's really two different ways that they can build scale. The first is that they can enter an entirely new basin. We saw that with Civitas, how they were a legacy DJ Basin player, but then they recently entered the Permian Basin through a series of M&A deals. And then on the other end of the spectrum, you have an M&A, a type of scale building where you buy new acreage, which is parked relatively close to your legacy acreage. This is known as contiguous acreage. And, we prefer this type of scale building just because it allows operators to drill longer well laterals, which in turn allows them to realize capital efficiencies, drive their free cash flow higher, and it basically helps their financial flexibility. I mean, we have a number of companies that we cover, even though they're on the smaller side, and the industry says that, scale obviously matters, even though they're on the smaller side. They're still going to pack a big punch. If you look at their 2024 free cash flow on a barrel of oil equivalent basis, Cord, Magnolia, for example, even though they're smaller, they may outperform some of their larger peers. But I think our bottom line still remains the same for these types of companies, which is, to continue to remain competitive, to continue to remain relevant, you're going to have to build scale, continue building scale through M&A. And then, I've been talking a lot about M&A, and really we think that, aside from this, there's another way to stay relevant in this industry for the small and mid-cap peers, and that's really having low debt, right? Low leverage, low debt. It enables you to have financial flexibility, especially during times of subdued commodity prices, which is important. And also at the same time, it gives you a greater ability to return cash to shareholders in the form of dividends, share repurchases, base variable dividends, and that's what investors want to see in this space. So that really wraps up my part of the remarks.
Thank you so much, Evan and Vince, for those introductory comments. Maybe just a quick note for everyone listening. You do have the ability to ask a question via the chat, and we'll try to work that in if you've got anything that's on your mind. But a couple of things come off for me, and hearing your comments on sort of cash generation, M&A activity, these kinds of things. I'm just curious, if you sort of step back philosophically, think about the industry right now, which kind of companies are have been rewarded the most? Is growth the priority, or is capital returns back to shareholders the priority at the moment?
So what it really is it's a great question, by the way, right? It's the balancing of the production growth and generating the free cash flow to offer the shareholder not only a growing base dividend, but also the supplemental payout as well. That's really based on the level of free cash flow. So let me give you an example. Diamondback Energy out in the Permian. It is a great example of an operator that has grown via consolidation, but has done a great job integrating the acquisitions. It is now a $53 billion company. It just closed a seminal acquisition of Endeavor, which is a private entity, one of the largest remaining private operators in Texas. It has a storied history. That consolidation allows it to combine two entities, create the financial engineering that provides significant free cash flow, but also steadies production and also refills the pool of resources or of resource potential that can create that longer life, that longer drilling life going forward. That's on the oil side. What we haven't seen much, Rob, is consolidation on the natural gas side. And recently, October 1st, this closed. Chesapeake and Southwestern merged to become Expand Energy. It's a very iconic name, I think. They are the largest independent natural gas operator. They combine both the Marcellus and the Haynesville, two prolific regions of the country. The Marcellus, which is a lower cost area, highly economic. Haynesville, closer to Gulf Coast export hubs, which is also very important. So we combined two entities that had exposure to both regions 1 plus 1 equals a little more than 2 these days. And that acquisition, I think, will set off an incremental series of consolidation in the space. There was concern on the part of the FTC that they would try and block this transaction. We had a focus idea when the transaction was first announced, suggesting that we would not see much of a pushback. And in fact, that comment period came and went. There was very little commentary from the FTC, and that acquisition closed without much issue, even though there were at least, I believe, 1 or 2 instances where additional information was requested by the FTC. But it seems that the FTC understood our point of view as well as some of the more bullish folks that this is a global gas market. While they have a sizable piece of the Haynesville and also the Marcellus, the gas molecules are fungible. They're coming from all across the country and headed down to the Gulf Coast because that's where the best demand hub exists with the best price, and that's where the opportunity set exists. So the market was seen as much larger than just constrained to the Haynesville and the Marcellus. So I think we're going to see more deals like this. But also, Rob, there's another point we want to try and make, and maybe we can get into it after this. But there are entities that have stayed pat and haven't touched M&A, and they're doing quite well, but they are few and far between. They have a very different strategy, and they are profiled as entities that understand the technology, understand the science of the regions that they're in, and they are leveraging that technology, that know-how in those regions. And rather than investing in M&A, they're internalizing that cash flow and building out their own resource base.
Okay, thank you so much, Vince. We have some questions coming in, so I think I'll try to field those as opposed to just ask you what's on my mind. Get you the questions that the clients want to know the answer to. So the first one, so the International Energy Agency has its World Energy Outlook out this morning. I haven't read it. Here's the one from 2010. These are always fascinating to go back and see what they were saying, 15 years ago. But in the one today, at least it sounds like there is some sense that oil and gas prices could be driven lower in the future by excess supply. And so I'm curious, just generally looking at the screen right now, Brent's in the mid 70s, Henry Hub's about in the mid 2s, $2.40 per MMBTU. So give us a sense, how does the underlying commodity price for oil and gas and the fundamentals there affect your thesis on the industry?
Look, this industry is well into the maturity phase. And we've talked about this for some time now. And how do you survive? You survive by consolidating. You survive by getting larger and owning more of that resource potential. I think it is more prevalent on the oil side because, at least on the natural gas side, we can argue that natural gas probably has a longer runway as a demand feedstock, whether it's via the global LNG market or what we most recently talked about at our last conference, Rob, the impact on technology demand to power these server farms. And that is going to be a incremental demand push. And I think it's going to be pretty significant, although not as significant as some of the more optimistic projections. But even if it does get close to that, you still have a long runway for natural gas, probably more so than you have for crude. especially for the transport side, because guess what? You can electrify every car on the road, but you still need a source. And that source is going to come from, all likelihood, the electricity side of the house. So power gen, nat gas feedstock into the power gen sector, I think that's a significant opportunity set. It has been for some time, and it continues to be. Nat gas is the number one feedstock for the power gen sector, and it will likely continue to chip away. So I think that runway is is added value for natural gas operators in terms of price. Look, I remember nat gas prices in the double digits. Okay, so we have seen nat gas benchmarks trend down for several years now. And this has been quite obvious. The reason why we have shale gas and the ease of this manufacturing cycle to extract this molecule has allowed for additional capacity to come on into the market. We were once an importer of LNG. Guess what? Now we are an exporter of natural gas into the global LNG marketplace, and that provides an avenue to push out these excess molecules. And I think that's an incremental positive, more positive for natural gas than it is for oil. And that's why we've seen companies on the oil side, at least, consolidate very, very quickly. It also includes the big integrated guys, Exxon dropping into the Permian Basin to pick up a rather large acquisition like Pioneer Natural. I think it says a lot about the efficacy of the Permian Basin and the molecules, the relatively cheaper molecules that you can find, and the repeatable resource in East Texas.
All right, cool. Thank you, Vince. Speaking on your mention of data centers and AI and how it could affect energy markets, I'll just quickly advertise on next week's call. We have Chris Kodomsky joining. He's the expert at Bloomberg NEF, our sister organization that focuses on nuclear power. And there was news out this morning about Amazon inking a deal to bring SMR, small modular reactors, to the market. Now, I want to bring Evan back into the conversation if we can. So, Evan, hearing Vince talk about the role of commodity pricing and kind of how to think about the space, I'm curious, especially when you think about the smaller names, some of the ones you look after. Is there a preference for more oily kinds of resource or more gas kinds of resource? And I'm also curious if there's sort of a psychological exit strategy in mind. Do these companies that are small want to grow, or do they want to get to some scale and then get acquired? So over to you, Evan. Evan, you're muted. You got to unmute. Sorry about that.
Yeah, sorry about that. So to answer the first part of your question, do they prefer oily parts of the acreage, more, gas levered parts of the acreage? I mean, I think it really depends on where commodity prices are, in the cycle. If you look, oil prices are pretty elevated, gas prices, still a little on the subdued side, I want to say, just given where natural gas inventories are in the United States. So really what you're seeing is, in order to maximize free cash flow, a lot of the small and mid-cap names are really, at least on the gas side, trying to target more NGL and oily parts of their acreage. You see this with, Coterra, for example, which has acreage in the Permian, the Anadarko, Legacy Appalachia, and they're really shifting their operations more towards the Permian and Anadarko just to take advantage of that. And the second part of your question, I really think, what's the psychology behind it? Do these companies, are they looking to stay basically in the game, basically continue to grow? Are they looking to be acquired? I think it really depends on each company's strategy. Really depends on which companies you look at. Companies like Permian Resources and Cord, for example, these companies have been conducting a lot of M&A at a rapid scale. So, our view is pretty much that these companies are probably here to stay. Some other companies like Pioneer, for example, obviously a larger company, but it seems like their strategy was to build to be acquired.
So let me just add to that. When we talk about this grow to sell strategy, let's delineate the public entity versus those that are sponsored by private equity firms. In the case of those private equity firms, the basis behind injecting cash into these PE-sponsored shops is to build a franchise, invest in that franchise with the eventual end result to sell or IPO that franchise. In the more recent acquisitions around the Permian and in a few instances outside of the Permian, these private entities were growing quite rapidly, and they were growing quite rapidly in order to present a picture of an entity that had resource potential, that had acreage, that also had production. And so what typically happened when the companies were acquired by public entities who used elevated currency to buy these entities, the public entity integrated the private shop and reduced the number of rigs, reduced the activity level, thereby generating incremental free cash flow, building that free cash flow yield to financially engineer a transaction that was quite positive for the acquiring enterprise. And when we say outperforming, what we're really talking about is the operational and financial metrics of the entity, outperforming based on the amount of free cash flow that has been generated, outperforming with respect to the amount of output relative to the amount of capital that's invested in the enterprise.
Thank you, Vince. Very, very interesting to hear the perspective there. There's several questions that we've had come in from our clients that revolve around alternatives. So hydrogen specifically. So we've got several questions on one's on natural or geologic hydrogen, others just hydrogen diversification into renewables. So we've had Will Hares on a number of times, and we kind of know this story about the oil majors or the energy majors, at least as the European majors want to be called these days, and this kind of transatlantic divide that's occurred there. But Vince, when you get into the E&P space, my sense is that this kind of stuff is smaller. But you tell me, what does hydrogen feature into any of these companies' strategies or any other kind of diversification?
Yeah, so it is a modest investment for these companies where my guys are spending their dollars. They're spending their dollars on the acquisition side, buying oil and gas traditional legacy assets. They're also spending their dollars on incremental dividends to support shareholder engagement. Balance sheets have been in pretty good shape, so we're not looking at defeasing debt, paying back debt to improve the financial flexibility of the enterprise, but you are seeing maturities get paid down as opposed to just refinanced. So buybacks are also a part of the mix as well. So when we look at capital allocation, it's really been internalized for the balance sheet earlier on. It's been M&A, and then it's been shareholder distributions with these alternative fuel sources, these alternative strategies, lower on the priority scale.
Okay, we are running up on time here. There are a few more questions. I'm not sure we'll get to all of them, but I think it would be a missed opportunity if we didn't go into sort of your expectations for U.S. production growth, U.S. output growth. So give us a sense. You've done this big deep dive. Where's U.S. production headed in 2025?
So I will tell you that we will have a natural gas focus idea out before the end of the month, looking at the winter heating season and what that means for 2025 production. So I'm not going to push off that question, but I will tell you is from what we're seeing and from what, excuse me, from what the data that we're looking at, our conversations with management teams, it's more likely than not production growth will be fairly muted on the gas side. When we say muted, very low single-digit % growth, especially through the first half of the year, just because of where prices are. I think the uncertainty on the election side, the uncertainty in terms of broader geopolitics, oil production is likely to be in that modest single-digit growth trajectory as well. Remember now, the key for investors is less about production growth and reserve growth, but more about the growth of free cash flow returns to the investor relative to the amount of capital spent to find and produce additional molecules.
Okay, we'll have to leave it there as the last word. We're a couple minutes past our time. So just reminder for everyone, you can find Vince and Evan's report by looking them up on bio or hitting BI deep on your terminal, or just shooting us an IB or an email. We'll make sure we get it in your hands. It's a very cool piece of research, and I hope everyone has an opportunity to check it out. And as a general reminder, we hold these calls every Wednesday at the same time. We kind of rotate through the team. Next week's a kind of special guest where we're going to talk nuclear. But we try to make this interesting. If you've got a topic or a guest that you think we should have on, just let us know, because we're open to that. We want to be as useful for you as possible. So thank you again so much, Vince and Evan, and we look forward to being in touch. Take care, everyone.
Thanks again.